Take a second and scan whatever's within arm's reach. Your phone, the screen you're watching this on, the Wi-Fi box blinking in the corner, the light switch you...
That's electrons obeying hardware. Billions of tiny decisions happening at insane speed, every day, everywhere.
And here's the part almost nobody connects. A shocking amount of that modern miracle leans on one specific element, not lithium.
The key takeaway from these charts is simple. We're seeing clear indicators that this is not gold, despite the initial projections.
Tapping here, we can see the surge is clearly not oil this quarter. The growth metrics are concentrated elsewhere.
Not even copper. Silver, element 47.
For most of human history, silver was money. Minted, saved, fought over, treated like the backup plan when everything else failed.
But in the last century, something quiet happened. Silver didn't disappear, it got reassigned.
It moved from coin and vault into circuitry and infrastructure, into the parts you never see but absolutely depend on. And once you notice that, you can't unsee it. Satellites, solar hardware, medical systems, data centers.
So here's the question that should bother you. If our entire civilization is built on this metal being cheap and easy to get, what happens if that assumption is?
What happens if the real story isn't inflation or hype, but physics? Because physics doesn't care about opinions, and you don't innovate your way around hard law. In this video, we're not doing price predictions, and we're not chasing next week's candle. We're gonna zoom out and look at the next decade, the demand engine. This isn't a trade alert, it's a case file on the metal modern life can't run without.
Pick up the device in your hand and look at it like an engineer, not an investor. Your phone isn't just glass and pixels.
It's a dense, silent machine for moving electrons on command through switches, contacts, solder points, circuits.
Now look around your room.
The recent surge in data traffic highlights the critical role of robust infrastructure, the movement through the network components.
As you can see, the underlying infrastructure shows significant movement. This data flow is directly impacting the current market volatility we're observing.
The screen that never stops glowing. Modern life is not digital in some abstract, cloud-like sense. It's physical.
We are seeing the impact across the board, as illustrated here.
It is electrified matter, and hidden inside that electrified matter is a metal the world still talks about like it's a hobby: silver.
The real story isn't that silver is shiny or historic or undervalued by a chart.
The real story is that the modern engineering stack quietly leans on one element more than most people can name. For centuries, silver lived in the public imagination as money. Minted, hoarded, fought over, not overnight, but methodically, as industry absorbed it.
Over the last 100 years, silver didn't disappear. It got reassigned. It stopped being primarily a store of value.
That reassignment matters because it changes the nature of demand at the deepest level. When something is valuable, people can choose to buy less of it. They can wait. They can switch preferences.
They can follow fashion.
But when an input becomes infrastructure, when it becomes part of the circuitry that makes systems function,
The world doesn't keep buying silver because it's excited about silver.
the world keeps buying silver because the machine breaks without it. That's not hype.
This highlights the key factor. That's how dependencies work. Now let's look at the historical data.
And once you see the dependency, you start noticing how invisible it is.
T-shirts. No one celebrates the metal in the contact that keeps a grid stable. No one posts about the conductive pathways inside of
The public sees technology and imagines software.
The real bottlenecks live underneath, in materials and manufacturing choices that either conduct, endure.
It's an enabler, a material that earns its place because its properties solve problems that are non-negotiable at scale.
You can substitute on paper, you pay in performance in real life. You can cut corners, pay in failure rates, heat, inefficiency, and brittleness when system.
And that's the investigative turn the narrative takes right at the beginning. Silver isn't a niche investment story.
It's a dependency story hiding in plain sight.
It's the metal quietly underwriting communication, electrification, and modern manufacturing, while the public debates it like a collector's item. Once you under.
It starts sounding like an audit of the real world, an inventory of what modern life physically requires, whether anyone is paying attention or not.
Once you accept that silver isn't just present in modern life, but structural to it, the next question becomes unavoidable. Why?
This is where the story stops being about markets and turns into something colder. Something that doesn't care what anyone believes. Because silver's real value isn't a narrative, it's physics.
And physics doesn't negotiate. The periodic table is not a social media debate.
You don't brand your way around it. You don't vote it up or down.
When engineers choose materials, they are making trade-offs against hard limits. Conductivity, resistance.
And silver sits at the extreme end of several of those curves in a way that is annoyingly difficult to replace. Start with the one that matters most in an
Copper is the baseline. Cheap, common, good.
But silver is better. Not better in a poetic sense, better in the literal, measurable sense that it conducts electricity with less resistance.
That sounds like a small advantage until you remember what modern systems are. Billions of connections, trillions of switching events, enormous networks where... In a device you hold in your hand, in a power system feeding a city, in any environment where reliability matters, Then the script widens the lens beyond electricity. Silver is also framed as a light metal, one that handles...
That's why it appears anywhere precision, optics, and energy conversion collide.
Light is not a vibe, it's a physical input. When you're trying to capture, direct, or manage it, you choose materials that behave predictably under stress.
Again, this isn't luxury demand.
It's functionality demand that is driving these charts upwards, as you can see here.
The market doesn't keep pulling silver forward because it looks good in a vault. It keeps pulling silver forward because in critical places...
And that's the trap hidden inside the substitution argument people love to repeat.
Yes, you can swap materials. You can make alternatives work. But the script's point is sharper. Some substitutions...
It fails in efficiency, fails in reliability, fails in heat management, fails in longevity, or fails in the economics of mass production.
That's why silver keeps getting selected, even when it's inconvenient, even when it's expensive, even when executives would love to delete it from the bill of man.
Because if the world keeps electrifying, and it is, then the need for silver isn't a forecast.
It's a consequence.
Once you've locked in the first two truths, that silver is embedded in the machinery of modern life, and that its advantage isn't a story, but a set of physical effects.
It's driven by deployment. And right now, deployment is accelerating.
A solar panel isn't a green symbol. It's an industrial machine that takes photons and turns them into usable electricity.
That conversion is not magic, it's metallurgy and manufacturing. The panel has to collect charge and move it efficiently through conductive pathways, and the
In that framing, silver isn't a decorative input. It's a throughput requirement. you want mass-scale solar deployment, you need a continuous river of the metal that can move electrons with minimal losses and survive harsh conditions. But the story doesn't stop at panels, because the writer knows a single end market can be dismissed as a cycle.
Electrification isn't a product category. It's an architecture shift. It's power management systems in everything.
It's grid upgrades that add switching, protection, and connections at every node.
It's charging infrastructure in public and private spaces, multiplying contact points and high-reliability pathways. It's data centers, warehouses of compute that drink electricity like a living thing, then demand even more hardware to keep it flowing cleanly.
And it's the steel.
Each device might use only a small amount of silver, but the script's point is ruthless. Units multiply.
The world doesn't need 1 billion new machines. It needs tens of billions of new components inside billions of machines. When scale does that, small amounts be.
This is the rhetorical move that makes the demand story hard to escape. Silver demand is not a single wave you can surf and forget.
It's layered. It's layered. Even if one end market slows, if solar growth pauses, if consumer gadgets have a weak year,
Civilization is wiring itself tighter. And the more you wire a system, the more it depends on the materials that carry charge and endure stress without failure. That's why the script justifies the phrase "bigger than 1980," not because it expects a one-time speculative frenzy. It only needs the world to keep doing what it is already doing, building a future that runs on electrons. If the last point was that the demand engine is accelerating, solar, grids, chargers, data centers,
People substitute towards these assets when the traditional markets show volatility. As you can see in this report, the trend is accelerating.
projects get canceled. Consumption gets delayed. The market self-corrects.
But the key takeaway here, and what the data consistently shows, is that silver is built differently. This structural demand underpins its long-term value.
Not emotionally, mechanically. Because the way silver is used makes demand unusually price inelastic, tiny per unit, critical to function.
Here's the trick the narrative keeps returning to. Silver is rarely the headline cost inside the products that depend on it.
Dispersion. In a phone, connectable pins, a high reliability switch.
Think of silver like a small ingredient that makes the recipe work.
You can argue about the price of flour or the cost of the oven, but if the ingredient that activates the whole dish gets removed, you don't get a cheaper dinner.
And if that ingredient doubles in price, the total cost of the meal barely moves. The manufacturer doesn't stop cooking.
They pay the new price and move on, because the real expense is the assembly line, the labor, the distribution, the warranties, the brand risk, the downtime, EVA.
When engineers specify silver in a contact or conductive layer, they're buying reduction of losses, reduction of heat. Those outcomes are worth far more than the metal's line item on a bill of materials. So the usual market discipline, price.
Buyers don't vanish because they aren't buying silver as a discretionary good.
They're buying it as a reliability input. They're buying it because the system must stay on. Now connect that to the demand waves you already established.
Solar doesn't get built because a consumer feels like it. Grid upgrades don't happen because a household wants a luxury.
Data centers don't expand because the internet is a fashion. These are infrastructure decisions, and once they're underway, they behave like commitments.
If the price of silver rises, it doesn't automatically stop a utility-scale build-out or the manufacturing of millions of devices.
The script's claim is blunt. Substitution is limited, and demand destruction is muted. So the why.
And this is where the logic becomes a trapdoor.
If demand doesn't back off easily and supply can't respond quickly, The balancing mechanism isn't more production next quarter, it's repricing.
Potentially violent repricing, not as a prediction, but as a structural outcome of a market where the critical input is small, necessary, and hard to replace.
When industry behaves like a forced buyer, silver doesn't trade like a normal commodity.
It trades like a bottleneck. And here's where the script tightens the trap. If demand behaves like a forced buyer and won't back off cleanly, the textbook responds.
That's how most people imagine commodities working.
Price goes up, miners rush in, production ramps, the shortage fades. But the argument pivots on a detail that flips that intuition on its head, the kind of most.
A look at the screen reveals the key component, a bonus stream that wasn't priced into the initial reports. The efficiency here is remarkable.
A byproduct captured while someone else is actually driving the car. Much of the world's silver come out of operations whose real business is lead, zinc, copper,
And that distinction matters more than any chart, because it means silver supply is not fully price elastic to silver.
In plain terms, even if silver price spikes, a lead zinc producer doesn't instantly triple throughput just because silver got hot. They can't.
Their mine plan is built around the primary metal's grade, recovery, and demand.
Their permits and environmental limits aren't written for silver mania. They're written for a certain tonnage of rock and a certain processing capacity. Their mill can only grind so much. Their smelter contracts have fixed constraints. Their capital budgets are approved years in advance.
Their executives answer the economics of the main product, not the byproduct credit that shows up as a helpful line item at the end. This is the built-in Han.
Silver can scream. The system may barely turn its head.
That's why the script frames the market as lacking a true seducer.
The driver can crank the price signal, but the machine responds slowly, indirectly, and sometimes not at all.
Put that next to the inelastic demand you just established, and the asymmetry becomes the point. Industrial demand can rise quickly. New factories come online, deployment curves steepen. Electronics multiply, slow to turn, slow to accelerate, partially indifferent to the very price signal people assume controls it.
That's how deficits persist with an automatic rescue, and that's why this.
The script sharpens this with a simple, brutal trend. Ore grades are falling.
That phrase sounds technical, almost boring, until you translate it into what it actually means. A lower grade is not just less silver, it's a multiplying burst.
It means you have to move more rock to get the same ounce.
As you can see from the charts here, the increased demand means we need more raw materials. More rock.
The data suggests a significant uptick in resource allocation. This translates directly to the increased activity we're tracking in the mining sector. While the upstream indicators remain strong, the real bottleneck is further down the line. We're seeing capacity stretched thin at the mills. More diesel, more electricity, more water, more parts, more labor, more maintenance, more everything, just to stand still.
The cost isn't linear, it stacks. And as grades decline, silver becomes increasing.
This is where the script forces the viewer to abandon the fantasy of quick fixes.
People talk about new supply like it's a tap you can open.
But a mine isn't a warehouse. It's a living industrial system anchored in physical terrain, regulatory reality, and long timelines.
Before a single commercial ounce comes out, you need exploration and confirmation.
You need feasibility studies and financing. You need environmental reviews, water rights, community negotiations, and permits that can take years.
You don't flip this on in 6 months because the spot price is exciting.
And even if you had approval tomorrow, you still have physics and logistics, equipment lead times, skilled labor constraints, construction seasons, commissioning.
That time lag becomes the persuasive knife.
The script's underlying line is basically this. If it takes roughly a decade, often more,
That converts a messy industry reality into a clean conclusion anyone can feel. The world can want more silver, but geology, permitting, and time won't cooperate.
you can raise the price signal, you can shout into the market.
But you can't negotiate with the depletion curve of mature mines, and you can't speed run the physical construction of a new mine without paying somewhere else.
This is why the phrase supply cliff isn't just drama in the script. It's an emotional anchor for a structural timing mismatch. Old mines deplete. Grades decline. Replacement projects arrive slowly and in limited number. Meanwhile, demand is accelerating now, today, driven by electrification and industrial throughput. So the market starts drawing down what it can draw down: inventories, stockpiles, the visible pool of ounces that can be mobilized quickly.
And once that buffer shrinks, the balancing force isn't more metal next quarter. It's price repricing, because the system has run out of other levers.
Because once you realize supply is constrained by physics and time, the next uncomfortable truth is that it's also constrained by borders.
The script introduces geopolitics as the third stressor, not to add drama, but to show how fragile the system becomes when the remaining supply isn't just scarce.
Critical metals don't move through a vacuum. They move through jurisdictions, customs, smelters, contracts, and shipping lanes.
And when a large share of global silver output is tied to a limited set of producing regions, often through byproduct streams attached to large base metal operations. A lead-zinc mine doesn't just wake up one morning and decide to double production for silver. It answers to regulators, labor rules, energy prices, export.
That's what makes the supply chain vulnerable in a way most investors don't model. The ounces aren't just in the ground.
They're in systems. And systems can be interrupted. Now imagine a policy shift, a new tax, a tighter environment.
None of these need to end mining to matter.
They just need to slow throughput. They need to delay shipments. They need to complicate refining or reroute supply through less efficient channels.
That's enough to tighten a market that was already operating with thin slack. The script's point isn't that disruption is guaranteed tomorrow.
It's that the system is built in a way where disruption matters more than people assume, because the cushion is smaller than the headlines imply. And that's where the argument gets shamper. The visible silver market is portrayed as hand-to-mouth, unlike some commodities where governments maintain large.
When the buffer is thin, shocks don't get absorbed, they transmit. They show up as delivery stress, widening spreads.
This geopolitical layer functions as a multiplier on everything you've already established.
Even if you're optimistic about mining investment, even if you believe recycling can improve at the margin, geopolitical risk means the market can still experience.
Supply is concentrated and vulnerable.
That asymmetry is the underlying pattern the script keeps hammering. Silver is a strategic input masquerading as a boring commodity, until the first real shock.
Fine, the argument goes, maybe new mines are slow, maybe supply chains are fragile, but we'll just recycle what we already have. And this is where the script...
Not because recycling is impossible, but because silver doesn't behave like a hoarded metal.
It behaves like a consumed one. Gold is money in the most literal, physical sense. It sits, it waits, it accumulates.
It is dense value that people protect, pass down, and melt back into bullion when needed.
Gold circulates through the economy and returns. Silver is different because it lives in two worlds at the same time.
Yes,
It can be money when it's held as bullion.
But in the industrial age, it also became fuel, an enabling input embedded into products that get used.
The implication is stark. Most of the metal didn't vanish into a vault.
It vanished into dispersion, scattered across landfills, industrial waste, and microscopic layers inside billions of devices.
That mechanism has a name, and it's colder than any market narrative. Entropy. Concentrating metal into a bar takes energy and intent.
Dispersing it takes almost none.
Once silver is smeared into thin films, conductive pastes, contact layers, solder points, and tiny components,
The script uses history to show this isn't hypothetical. Photography was the early wave. Silver consumed in chemical processes and scattered.
Electronics are the modern wave, and arguably the worst one, because the scale is larger and the silver is distributed even more thinly. This is why the recycling. You can recycle silver, but the question is not can. The question is at what price, at what throughput, and at what energy cost. If you need to process mass,
Otherwise, the metal remains effectively trapped, present, but inaccessible at market speed. In the script's framing,
Not because everyone wants it to be that way, but because the system is optimized for manufacturing efficiency and consumer turnover, not for element recovery.
and the implication lands exactly where the argument has been heading. If demand is accelerating, if mine supply is handcuffed and slow, if geopolitics can tight,
Gold can lean on above-ground stocks because it comes back.
Silver keeps getting rarer in usable form even as it becomes more widely used, because dispersion destroys recoverability. That's not a sentiment. That's the math of a civilization built on tiny, essential traces.
once you accept that recycling can't magically refill the tank, because so much silver has been dispersed into microscopic, the script treats these inventories like the last accessible pool of metal that can respond in real time, and it frames their decline as the tell that matters.
so when the market needs ounces quickly, it doesn't go to geology, it goes to stockpiles.
And if those stockpiles are draining, you're watching the system burn its emergency fuel. The narrative points to the public vault ecosystem. Think the big, cent. This isn't about total silver somewhere on Earth. It's about silver that is registered, deliverable, and available to meet claims in the visible market. The script emphasizes that this category has shrunk dramatically compared to recent years, framing it as scraping the bottom of.
That's the mechanical setup for stress. Because when the buffer thins, the system becomes sensitive to behavior.
A small change in how many participants demand delivery can create outsized effects.
And that's where the story leans into the paper versus physical tension, not as a conspiracy slogan, but as a structural vulnerability.
Most of the time, they function because most participants treat settlement as financial, not physical.
But the script argues that when prices are held too low relative to real scarcity, the incentive flips.
Each removal tightens the visible float further. The pricing mechanism becomes fragile not because it's fake, but because it depends on confidence that claims wow.
If that confidence erodes, the system have to reprice to ration demand and attract supply, fast.
Then the script adds the second pressure that turns a supply and demand story into an endgame, the potential return of monetary demand. High debt loads create.
In that environment, savers look for hard assets.
Gold is the first stop until it becomes too expensive for the average person. That's where the script positions silver as the people's money, not in a romantic.
Now the math becomes unavoidable.
Inelastic demand meets constrained supply, meets shrinking buffers.
That's the triad. And once those three forces converge, the script argues the outcome isn't a neat, gradual adjustment.
It's forced repricing, potentially bigger than 1980, not as a one-off speculative spike, but as a regime change in how silver must be priced to clear a market.